Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about silver, precious metals, economics and politics. Today is Friday the 8th of February 2019, and we're discussing an article published in this week's edition of Financial Advisor, written by Saloni Sardana, a feature writer for the publication, and it's entitled Cryptocurrency Lessons of 2018. This article briefly covers the performance of cryptocurrencies, particularly in 2018, and also provides the views of the UK Regulator and a number of financial advisors and their approach to this new investment phenomenon. Firstly, we shall read the article, which is a little lengthy, and then discuss it. Cryptocurrency Lessons of 2018. Those who fell prey to last year's cryptomania craze and purchased the digital currency had more to regret than celebrate at the end of 2018. Bitcoin, the oldest and bellwether cryptocurrency, closed at $3,769.91, according to exchange operator CoinDesk, on December the 31st, 2018. The cryptocurrency, along with others, had been extremely volatile throughout 2018, trading below several highs seen in the previous year. It hit the $20,000 mark in December 2017, and experts had speculated that the price could exceed $50,000 in 2018. But 2018 proved to be a tumultuous year for cryptocurrencies, marred by severe price swings, regulatory clampdowns, and volatility, with most cryptocurrencies performing poorly. The Bitcoin price index, an average of monthly prices, fell from $13,860.14 in January to $3,689.56 by December 2018, according to Statista. Ricky Chan, director and financial planner at IFS Wealth and Pensions, says, quote, "I think to advocates and casual observers of Bitcoin and cryptocurrency, abysmal performance in 2018 is an understatement, with huge losses being experienced across the major cryptocurrencies. Some predicted Bitcoin to exceed $100,000 before the year end," unquote. So why did cryptocurrencies default on expectations, and what lessons can be learned? Mr. Chan adds, quote, "I think many naive individuals suffer from FOMO, fear of missing out. So many piled into cryptocurrencies thinking it was a get-rich-quick scheme. For skeptics, it was expected not to hold such wild valuations, and many steered well clear," unquote. Neil Liversidge, managing director of West Riding Personal Financial Solutions, says, quote, "Bitcoin completely met my expectations. It crashed, and so did the others," unquote. Bitcoin lost 40% of its value in January 2018 alone, thanks to new regulations in South Korea, as well as an announcement that Facebook would ban the advertising of crypto exchanges. More uncertainty flooded the cryptocurrency market when Facebook later lifted the ban, followed by Google, which adopted a similar ban before backing down on it. In addition to this, financial institutions across the world have been divided in their response to cryptomania, including Goldman Sachs, which surprised the market by opening the first Bitcoin trading operation on Wall Street. However, other cryptocurrencies, such as Ripple, which is also used as a blockchain distributed ledger by several institutions, fared less poorly. The price of Ripple fell less than the dramatic price swings suffered by Bitcoin at the start of 2018. Ripple is currently trading at around 33 cents a token, lower than the $2.24 at which it was being traded at the beginning of 2018, according to Cryptocurrency Chart. Quote, "The large drop in prices has been accompanied by an increasing skepticism This is possibly due to the fact that the promise to bypass the centralized economic system and enable peer-to-peer payments has been disappointing so far, unquote, says Danielle Bianchi, assistant professor of finance at Warwick Business School. Major players in the world of finance, such as Berkshire Hathaway's Warren Buffett and JP Morgan Chase's chief executive Jamie Dimon, have criticized cryptocurrencies in mainstream finance. The Financial Conduct Authority has also taken a tough stance on cryptocurrencies and is currently exploring which assets fall under the regulatory perimeter. The UK Regulator will be consulting on perimeter guidance in early 2019 to provide clarity to consumers and companies as to which cryptocurrencies fall within the existing regulatory perimeter and which will fall outside it. On January the 23rd, the City Watchdog published a 50-page consultation report stating it expects providers carrying out regulated crypto asset activities in the UK to obtain the appropriate authorization from the Financial Conduct Authority. The FCA defined crypto assets as tokens that have characteristics that are similar in nature to traditional instruments like shares, debentures, or units in a collective investment scheme. However, regulation of cryptocurrency exchange tokens such as Bitcoin, Litecoin, among other key cryptocurrencies were not mentioned in the document. This is because the FCA defined them as tokens, which are not issued or backed by any central authority. The FCA will consult separately in early 2019 on whether to impose an outright ban on the sale of derivative products referencing cryptocurrencies, including contracts for difference to retail consumers. The volatility shown by cryptocurrencies in 2018 begs the question, should financial advisors be steering away from them completely? This is, in fact, the view echoed by several other financial advisors. Richard Stammers, Chief Investment Strategist at KW Wealth, notes, quote, "We have no idea how financial advisors could use cryptocurrencies to earn returns in 2019, nor why they would even consider trying to do so," unquote. Mr. Liversidge adds, quote, "I think they're as risky as it gets, and they're not investments. They're purely speculation on bits of computer code. At least in the tulip mania, the buyers got a tulip bulb for their guilders," unquote. Jason Whitcomb, Chartered Financial Planner at Progeny Wealth, adds, quote, "Advisors can help clients avoid speculation in cryptocurrencies by having an ongoing dialogue and relationship and being seen as a sensible sounding board," unquote. Some commentators say financial advisors can include cryptocurrencies in clients' portfolios, albeit in small allocations. Bo Giannani, Chief Executive of Ternary Intelligence, which recently launched hedged Bitcoin, says, quote, "A relatively small allocation, up to 10%, in cryptocurrencies could benefit portfolio diversification dramatically," unquote. Philip Nunn, Chief Executive Officer of Wealth Chain Capital, says there could be some potential with new types of products coming to the market in 2019. Quote, "Bitcoin ETFs will be approved and also lower risk products that specifically focus on companies with a blockchain strategy in the medium term. I would imagine when the product suite becomes available, some advisors will look to allocate small amounts, maybe 5%, into this kind of offering," unquote, he adds. But steering away from cryptocurrencies completely seems a more popular option than the diversified approach flagged by Mr. Giannini. Mr. Liversidge says, quote, "Clients should not be invested in crypto, and if they are, then the rest of us are likely to pick up a compensation bill from the Financial Services Compensation Scheme, because regulated advice is compensatable even when the underlying investment is unregulated," unquote. Despite the new offerings coming to the market, Mr. Nunn says that at present advisors should not be allocating any of their clients' money into cryptocurrencies. He explains, quote, This is a very niche market, and it's not for the faint-hearted. 70% losses are normal in the space, and clearly, if you have a long-term financial goal, it could be derailed by such losses." Unquote. In a nutshell, at least according to Saloni, the article paves the way for a blockchain currency investment product to fall within the legal financial framework and will enable advisors to include it in an investment portfolio recommendation. However, it does not include Bitcoin or Litecoin, or at least not yet within that parameter. That said, some financial advisors are clearly prepared to recommend these products, albeit as a small percentage of an overall portfolio, but accepting the fact that such advice may render their firm liable to compensation claims should the investment go awry. Our take on this, or at least our current take on this, is that cryptocurrencies should not necessarily be seen as an investment, but as a speculative medium of exchange, in other words, a currency, where its value can rise and fall, but with perhaps larger than normal gyrations. In the past, whenever we made financial recommendations, there was always an element of cash holdings, and to the more enlightened amongst us, a small level of gold holdings, though admittedly the latter was rarely taken up. How the regulators deal with this is anyone's guess, but deal with it they shall. But what hasn't gone unnoticed to us is that any general acceptance of cryptos within an overall investment portfolio is likely to crowd out, to some extent, any provision made for gold and silver. So whilst we can see the speculative attraction of Bitcoin and other cryptos, we can also envisage a slight deviation from gold and silver investments to compensate. This should not be the case, as gold and silver should merely be portrayed as a currency hedge. But in investors' minds, and sometimes advisors' minds, they will want to stick to the tried and tested formula of equities, treasuries, bonds, property, and cash. What's your opinion? Do share it in the comment section below. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.